And welcome to the show.
All right. It is going to be the 29th of September on Sunday.
Yep.
The market is defying all reasonable expectations. It never ceases to amaze me. If you push all your chips in on an expectation of something to happen, and then you stick to that line, you're either going to be very right or very wrong.
Yeah, there's no place for that in this world.
No. I mean, it was from all the cyclicals and all the stuff that everybody was talking about, recession and everything else. It hasn't happened yet. The cyclicals, they cycle. So when we get past the middle of October, the cyclical difficult seasonality for the market is over, and there's a big upswing cyclically in November and December. Now, everybody wants to hold on to that for sure, right? Everybody wants to say, well, we got through the down cycle without having a down in price. That means that the November, December is going to be really good, right? It may be.
Maybe.
Maybe not, right?
Yeah. What's the only thing that matters?
Price.
The price today.
That's all you can do.
You just respond to the price.
It's kind of amazing, and there's a whole lot of one of the big things we're going to talk about in the newsletter. I'm not going to get into the details of it here, but definitely the big news of the week is what's happening in China, and China is the kind of the focus of this podcast, which is kind of odd, but it has nothing to do with what we're talking about in the newsletter. But a huge Chinese central bank coming to the rescue in China, and it's having an effect all over the world. All right, so let's get into it. Weekly podcast, 29 September 2024. So we'll talk about what happened this week in the U.S., not so much China, but it does apply to China because the new I Fund. So the new I Fund, the new index started in the first trading day of September, and we're going to kind of talk through that and see what we're going to try to do about it. I just want to touch on this one idea of dividend-adjusted price as opposed to regular price, and we'll talk about that kind of an overview, and then not new TSP ticker symbols per se, but I'm going to kind of refine them a little bit, and then the TSP fund charts. So what happened this week? On Monday, we got S&P Global Composite PMI. So PMI is the Purchasing Managers Index. It's what purchasing managers for companies go out and they buy, stuff for their companies so that their company can make the products that we buy. So it's basically a gauge of inflation of corporate inflation, not personal. So what the purchasing managers are purchasing fell last month, but it didn't fall as high as expectations. So they were really expecting inflation to come down from a purchasing perspective. It came down, but not as much as expectations. S&P was up 0.25% that day. Tuesday, the Case-Shiller Home Price Index. That's a really big one if you're tracking housing prices. Case-Shiller Home Price Index fell to 0, which after 4 consecutive positive months, which basically means home prices on average. Okay, that's obviously not where you live necessarily, but home prices on average were flat month over month. So that's actually good news if you're a buyer, right? Not great news if you're a seller. S&P was up 0.29% on Tuesday. On Wednesday, you got MBA, 30-year mortgage rate fell from 6.15 to 6.13, but mortgage applications also fell to 11% from 14%. You got building permits, which is, Toll Brothers and Ryan Homes and all that, putting in building permits month over month. It jumped to 4.6% from negative 3.3%. So there's definitely some activity going on in the housing market. S&P was down 0.22% on Wednesday, and then Thursday we had initial jobless claims that come in at 218,000 versus 222,000, which was expected. And then the 4-week average also fell. So that's good for the economy, right? You got fewer jobless claims for the week, and the 4-week average also fell. So less people are putting in for unemployment, which is good for the economy. and we don't have to worry about the good is bad anymore, because now that the Fed has already started this rate cutting cycle and it's not worried about inflation, if we have less people on the unemployment line, right, new jobless claims, that means the economy is picking up, and the Fed's not worried about that as an inflationary pressure because they already started the rate cutting cycle. So all of this is very bullish, right? All of this is really, really bullish. S&P was up 0.4 on Thursday. PCE's personal consumption expenditures index. So that is us. That's personal consumption expenditures. So it was up a little bit, right? 0.1 versus 0.2 that was forecast. Personal income, both income and spending were down versus what they expected. So that's, not great, but it's kind of a lagging indicator. And then the S&P futures, because right now it's like 9:45, so whenever in the morning, I was looking at this morning, futures were up by 0.25%. Okay, so all of this is bullish. Who knows what happens over the next couple of weeks, because you get the seasonal still trend. It seems like the market doesn't care about the election. There's no talk of that in financial media really that I can tell of how the election, one side or the other, would affect stock prices going forward. And at this point, I think it's odd. And there's also no talk of all the World War III hysteria that's going on.
Well, nobody wants to talk about it because nobody knows what the hell's going on. I mean, I actually I forget the analyst's name. He's an older guy, and he's been in the game forever. As a matter of fact, you don't see him anymore because, honestly, I think he's like retired, doesn't care. Yeah. But he still pops in every once in a while, and I love it because he shows up like in a T-shirt. He doesn't dress up anymore. He used to be on Crossfire, and I think he is like on the Democrat side. Shaved head.
Yeah, I know what you're talking about.
But I've seen him on a few programs lately trying to give some perspective to this, and it doesn't help. Because he points that out because basically, and it did come up about why isn't this impacting the markets, and it's because all the things you just said, like at any given time right now, there's no way you can guess what's going to happen. Like he was making some predictions about the fact that there's like 40 some days left to the election or whatever it is by Sunday, and he still feels like there's a couple more shoes that are going to drop. Like there's a few more things. Like what do you mean? Like we've already had a couple assassination attempts. We've had
what else could there be?
One president drop out, the vice president go like, what more could there be? And it's like, well, it does keep happening, and so that's scary. It's I don't know if it's scary. That's not the right word, but anyway. So all of these,
from a market perspective, though, it creates uncertainty, right? And supposedly
chaos.
Supposedly the market doesn't like uncertainty, and supposedly that's why it goes down going into the election.
Well,
and it's not.
Yeah, and then you have all of these other. So where I'm going with this, and I'm not going to do a great job of paraphrasing this explanation, but there's so many overlapping chaotic events right now. Yeah. So normally you've got like one or two, or whatever. It's an election year, and this. You've got all these overlapping things that are almost to the point, well, not almost, like they're almost impossible to analyze. Take the data and go, here's an assumption that's usable. Like it's just not possible right now. So, and this was kind of to the point that he made, was that understanding all of that's happening. What's happening is most of the people are just going, I don't care, right? They're just putting their blinders on. Yeah. And they're wherever they fall politically. This is more his point. That's where they're staying. They're not changing. They're just like, it's too much going on, and kind of the same aspect in the market, right? It's too much going on. I believe in the market. I believe the market always goes up. The market's going to go up. Yeah. And I don't know. That makes some sense.
Sure.
I think the wildest thing to me over the last I would say 20 years, is how much data has increased and accessibility of data, yet our ability to make decisions has gotten worse.
Yeah.
Because it's overload, right? And so it's information overload. So it's paralysis by analysis, and it's increasing significantly. Yeah. Where you just can't make a decision because there's too many inputs, and you're like, I don't know what to do. Yeah. That's what I see happening.
Yeah, it's kind of amazing. Some of the quant theories out there that will scrape Google, or now I guess ChatGPT, and look at how many times the word X comes up in a thing, and they'll make market decisions based on that.
Yeah, user psychology is huge. Not just I'm actually reading a book right now that's talking about using that sort of technology, not necessarily in the market per se, but in product development, and how users are actually, what they're actually doing versus what they say they're doing. Right? I may say that I don't have any interest in X, Y, and Z, yet if you go to my Google history, I'm all over it, around it, and whatever. So yes, I mean, what I was going to say a second ago, though, is with all that chaos and this analysis by paralysis by analysis, is the ones out there, and that's hopefully we're talking to you guys out there, the ones that are able to just quiet the noise, execute your plan, are the ones that are winning right now. Yep. Because they're not standing there kind of getting seasick. What they're doing is going, all right, ship's going this way, right? The market's going this way. That's what's happening.
Yep.
I don't care why, and this is what I'm going to do. And here's what I'm going to do if it doesn't, right? So have your plan. Have your lines in the sand, know what your plan A and your plan B is, and just execute it. And if you want to listen to the noise, great. Like if you're really into all that, but you have to ignore it when it's time to make these decisions. That's the best advice I've seen out there so far. And in the bigger picture, the ones in the financial industry that are doing that the best right now are the ones that are winning by far. Yep. They're just, no, I'm not going to listen to the chaos. I'm just going to see what the data says.
The one of the best examples of that is JC Peretz. If you guys are not on his email list, you should get on there. He's a little, I think, a little bit obnoxious about the way he puts the stuff out, to be honest.
Yeah, I mean, he definitely has an ego.
Yeah. But he's most of the time he's right.
Yeah,
which is really why
I heard him banging hard on the Fear and Greed Index, the CNN thing, and I didn't have time to listen to his rant at the time. But I want to go back and find it and see what his argument was about. But yeah, he's one of many people that are public about it, right? So that's the hardest thing too, is finding people that actually, some of these folks that you'll never hear of them. Oh, yeah. You won't see them. Yeah. They don't care. They don't want publicity. Right. They're head down working, making money. And nothing wrong with that. But, the ones publicly, I think JC is probably one of those people, because he's also a hardcore technical analyst, right?
Right.
Like, he only cares about the price. He doesn't really care about your reason why.
Right. I mean, he just did, a couple weeks ago, he put up a chart of SMH's semiconductor index, and it's forming this head and shoulders pattern. And he talked about it, and he's like, hey, pay attention, because if this thing breaks the neckline, semiconductors are in big trouble. And then today or yesterday, he came out with a thing, and he's like, head, shoulders, knees, toes, feet, elbows, whatever. He's like, it's all nonsense, basically. Like, yes, the head and shoulders pattern is a real thing. If it broke this neckline, it would be a real thing. But more importantly, when it came down to the neckline, it got support there and broke to the upside. So he's like, what did you do? Did you stick with your plan of it's going to be a head and shoulders and it's all going to fall down? Or did you see that, no, it didn't. It got support at the neckline, turned, and came back up. He's one of the few vocal ones that doesn't say, hey, it's a head and shoulders pattern, run for the hills. He's like, it's a head and shoulders pattern. If it completes, then we'll respond to it. If it doesn't complete and it finds support and goes the other way, we're going to respond to that too.
Yeah, I read a really cool article. I was going to share it actually in our Facebook group and other places, and I didn't, because it's confusing, because it's written about a Canadian couple, and some of the things, if you don't understand what they're talking about, like, we don't have these things, but we do. We just don't call them something different. But this, I think they were both teachers, and they basically started out with about $150,000 in their retirement account, which initially it was very limited choices. Sound familiar? TSP kind of thing, or 401k. Lots of choices, but they're all really the same. And what they did was moved, a portion of their money, started putting portions of their money into a vehicle that they had access to, which would be equivalent to like our IRA, right? I don't know if they have the contribution limitations. So some of that stuff gets confusing, and like, if you don't know all that, you don't see the difference. But the gist of the story was, and where this connects to what you were talking about, is, first of all, they took their $150,000 and turned it into $2 million. in the couple, and on teacher's salary.
Yeah.
Pretty impressive, right? They're not making 150 grand as a GS14, right? But what they did though, I think it was they did together. Basically, they sat down, they did some similar sort of, narrowing down to things they understood, sectors they understood, and said, okay, I'm going to follow this. Here's my plan. Here's how I'm going to execute that plan. And if it doesn't go the way I think it does, I've got to. And it's all the stuff that we're talking about all the time. And regardless of what they did they get lucky? You could argue that. So they were investing in gas and oil at its lowest. Yep. And rode that wave, but that wasn't the only thing. So my point here, though, is they had a plan. They sat down. They said, "Okay, what makes sense to us? What resonates? What do I understand? What industries do I understand?" And they stuck with that, and they did that for their career, and walked away with $2 million that they can live off of, right? And so, when I read that, that's what I took away from it. Not, looking for stock picks.
Yeah,
No, it was that they sat down, they had a plan, and they executed that plan over 20 years, and they did pretty well.
Yeah.
And I think if that's the one takeaway, that's it.
Yeah. I hate to bring up the name Warren Buffett, but I'm going to do it anyway. Berkshire Hathaway is over 50% in cash at this point. Mm-hmm. So what that's telling you, and what he's said is he doesn't. There's no value.
He's not hiding this.
No, he's not hiding it at all.
Yeah.
There are no value. There's no companies that are undervalued to the point that he's a value investor, right? He wants to, just kind of like what you said with this couple. If you watch oil until it bottoms, and it turns back up, and it's an historic bottom, which it was. The oil a few years ago was negative. Do you remember that? It was like negative. I mean. So obviously oil prices were going to go back up, and if they rode that train, that's awesome. I want to say Buffett did it with Occidental Petroleum, but right now he's saying everything is overvalued basically, and so I'm sitting in cash waiting, because he always says it's patience. You make money in the market when you're patient, which a lot of people have a problem with because the market's going up and I'm not in it.
No, because they're not patient.
Because they're not patient, right? Yeah. So, anyway,
right, let's get past the rant.
That was quite the rant. And I think there's going to be more rants to going on this one. So, I didn't even come close to finishing. All right. So S&P Global Composite PMI Managers Index. Sorry. This is what that looks like. If you go to Trading Economics, we were talking about it last week. This is a really good website to go to. And so all you do, no, I didn't have the link. Okay, so this is the composite PMI. So it edged lower, but it beat forecasts. So basically what it's saying here is this. Things are getting better. Okay, let's just put it that way. Things are getting better. A moderation of order book growth and deterioration in business expectations for the year ahead, and a near 2-year low, meanwhile, reflected heightened uncertainty ahead of presidential election. Companies consequently held back on hiring and allowed employment to fall for the second consecutive month. In addition, average pricing charged for goods and services rose at the fastest rate since March. Okay, so that's kind of why I wanted to point this out. The companies held back on hiring and allowed employment to fall for the second consecutive month. In addition, average prices charged, so what we're getting charged, how we feel, quote unquote, inflation. Average prices charged for goods and services rose at the fastest rate since March. And input costs increased the most in a year. That's inflationary. Those are the kinds of things that would have been a problem for the Fed to, if they hadn't already started the rate cutting cycle. So you're going to have some inflationary pressures and there's a lot of deflationary pressures right now. But generally speaking, the economy is turning up from all the data. Okay, the new I Fund. So as everybody knows, probably, the old I Fund was the Europe, Asia, Far East Index. And the Europe, Asia, Far East Index did not include China. It included Hong Kong, but it did not include China. So we have now switched as of the beginning of September to this index called the MSCI All Country World Investable Market Index ex-US, ex-China, ex-Hong Kong. Okay, that's the index now that the I Fund is going to track. The problem is that index, there's no ETF or mutual fund that tracks that index. So the S Fund, or the I Fund rather, the I Fund doesn't have a ticker symbol. So there's no way that you can go into TradingView or Stock Charts or Yahoo Finance or Apple, whatever. You can't pull up a chart of this index. Okay. So I got a couple. We're going to talk through a few different things, but that's the problem. That's the big problem, is that there's no way for us. So what you would have to do really is go to the S Fund in I Fund. Why do I keep saying this? Go to the I Fund on the TSP website. Download the daily, closing prices that they give you on the TSP site. Put it in a spreadsheet and hit the chart button, and it'll give you a chart of that data. You can't do moving averages. You can't use all the tools that we use.
Well, just to be transparent, there are some ways to do it, but they're highly technical. Right.
Oh,
I'm doing it.
The tech guy is talking about it, right?
Yeah. I'm doing it. I've been working on it all since yesterday this morning. I woke up at 5 a.m. this morning doing it.
Good.
But
we need that.
Yeah, there are ways to do it. Is it as easy as opening up an app and doing, whatever? Now, our friends over at Daily TSP, right? They have an app. You can go into that app because they pull the data straight from TSP. They're not pulling it from anywhere else. There is no SPY or VX. There's none of they don't do ETFs and mutual funds to chart things. Now they also don't have like the charting functions in there. But if you want to see the performance in a given day for the I Fund, yep, it's there, yep, right? And so that's probably the only place other than the TSP website that you can go. Yep. But until they do create a ticker symbol, the only way to do it is to pull that data and put that into a charting software, which is pretty technical. It's not impossible, but it is highly technical. It's something that most people are not going to do, right? There's a few geeks out there that we're going to do it, but most people, to Jerry's point, like you can't just pull out your iPhone and pull up Yahoo and go, let me see, ex-US, ex-Hong Kong, ex-China. Right. Nope.
Yeah. So that's the problem. So let's talk about what the index actually is and the positives of it. So this is, if you go to the MSCI, if you Google all world ex-US, ex-China, ex-Hong Kong, it'll come up with the link to this basically data sheet for that index. Okay. So the index captures large, mid, and small cap. It's a representation across 21 of 23 developed markets, excluding the U.S., China, and Hong Kong, or excluding U.S. and Hong Kong, and then 23 of the 24 emerging markets. So you got developed markets and emerging markets, okay, excluding China, which is an emerging market company or country. So 5,523 constituents. The index covers approximately 99% of global equity opportunity outside of the U.S., China, and Hong Kong. So it's basically the whole world. Every country that is big enough to have an economy that that trades, right? I'm sure there's plenty of countries that don't, right? So you got 21 developed markets plus 23 emerging markets. The percentage, it's basically 50-50. From a market cap perspective, it's basically 50-50 emerging markets, developed markets in the index. So this is a chart. What they did here, and I'm going to zoom in on it on the next slide, but what they did here is the blue line is the actual index, right? It's the ex-China, ex-Hong Kong, ex-US. The yellow line is just ex-US. Okay? So you can kind of see they generally go up and down together. right? But there are some, like right now, there's a divergence, right? And you got the ex-China, ex-Hong Kong beating the ex-US. Okay, so what does that mean? If the ex-China, ex-Hong Kong one index is beating the ex-US one, it means that Hong Kong and China are dragging on the index, right? So as of this chart, because Hong Kong and the Hong Kong and China markets have been down, the index without Hong Kong and China is going to beat the index with Hong Kong and China. Does that make sense? So
it's clear as mud.
Yeah. So here's just a little bit of zoom in, and I couldn't make it any. I know it's fuzzy, but I couldn't make it any better. So the difference here, right? The blue one, the blue line, is the new I Fund index. The yellow line is that index that would include China and Hong Kong because it's just ex-US. Okay. So here's the thing. This is VEU, ticker symbol VEU. Okay. It's a Vanguard ETF. It's all world ex-US. Okay. So it would be the same as the yellow line right here. All world ex-US. So this week was a huge week because China is doing a ton of easing. This week is a huge week, right? We're up 3.7% for the week. Okay. That's all world ex-US. Okay. So that includes China and Hong Kong. So if you're looking at the VEU, which includes China and Hong Kong, because the idea is what we're trying to do is find a ticker symbol that is as close, since there's no ticker symbol for the new I Fund index, can we find a ticker symbol that's close? So if it's all world ex-US, ex-Hong Kong, ex-China, and we do an index that's all world ex-US, is that close enough, right? How important is the China-Hong Kong component of this thing? China makes up 7.7% of the VEU. It's a pretty significant amount, right? Hong Kong makes up 3.5%. Okay, so a little over 11% combined is China and Hong Kong. So it's a big percentage of it, right? Okay. This is FXI. This is basically China's S&P 500. It's been declining, right? Since 2021, it's been declining. So so the new I Fund, since it's excluding China, it's when China's going down, that's a good thing, right? Because the index doesn't include China. The problem becomes when China starts going up. This is the biggest up week. It's up 17% as of Thursday's close for the week. This is the biggest up week since 2008 for China. It's probably beginning a monster bull rally. If I had extended this out, this double bottom is almost back at the lows from 2008. So it's very likely. So if you don't care about the politics and you want to invest in China, obviously this is a huge. It'll likely pull back and whatever, but you got higher lows and this monster breakout. China's doing pretty good. And again, it's not in the index. This is Hong Kong. Hong Kong was up 13% for the week. So what I'm trying to get to is if you use the ticker symbol VEU, it is not including China and Hong Kong. So it's not. It may or may not be a great substitute for the I Fund index.
Yeah, I mean, I think we just have to state the obvious that it isn't, right? It isn't a good substitute right the second it's the best you have outside of making your own charts.
Right.
That's it. And so if you're watching this, write your congressman.
Yeah, I mean, it's absolutely unacceptable.
Yeah, all they really have to do is reach out to Morgan Stanley, who's MSCI. That's who that is Morgan Stanley. Reach out to hundreds of thousands of people reached out to their congresspeople, and one congressperson reaches out to Morgan Stanley and says, "Hey, this is unacceptable. We need a ticker symbol." They'll create one because it's Morgan Stanley. They can afford it.
Yeah.
Whatever contract they did,
Yeah.
whatever contract they did with the government to make this happen, will cover that. So. It's possible. It's just that nobody's asking for it. And honestly, in your interactions, you talked to them. I didn't. You talked to the Thrift Savings Plan, the board. It wasn't even on their radar.
No.
They were like, I don't know, like something to think about. But like, no, it's not something to think about. Like, we have to have it. That just tells you how much thought really goes into some of this stuff.
I don't want to go down that road.
It is bureaucratic decision making, and we know all know.
I mean, I get it. I just find it
We understand how it can happen. We still don't want to believe it.
So that's the problem, and so I just wanted to throw this one up as another potential something to think about. The black line is the old I Fund. It's the EFA. The red line is the VEU, right, which is XUS. And this is on a percentage basis. So they're pretty close. The EFA, the black line, also does not include China. It includes Hong Kong, but it doesn't include China. So it's possible that the EFA is still going to be our best option, especially if China and Hong Kong continue to rally. It's going to skew the VEU. It's going to make the VEU much higher on a daily percentage move than the I Fund index would be. So I still kind of think, at least for now, the EFA is probably a better ticker symbol to use as an approximation for the I Fund. But again, it's really not close. It's really not a good thing. Okay. So dividend-adjusted price. I got this from Investopedia, and so let me just talk through it. Dividend-adjusted return. So when investors purchase stocks, or in our case, the TSP funds, they expect that the stock price will increase based on their evaluation of the company, and at some point they sell the stock for a profit. The price at which they sold it compared to what they paid for it will be the return on their investment. Okay, so you bought it at a certain price, you sold it at a certain price. That's the return on your investment. This, however, may not actually be the total return on their investment. If the stock also paid out dividends during the tenure in which they held the stock, then this will need to be added in the return calculation, which then that is the dividend-adjusted return, which will provide the total return on the investment. So what I'm saying is the TSP, I took this from the TSP site. Okay, so the TSP, we're just talking about the C fund, but it's the same for all the funds. By law, the C fund has to be invested in a portfolio designed to replicate the performance of an index of stocks representing the U.S. stock market. So the board chose the benchmark to be the S&P 500 stock index, which tracks the performance of major U.S. companies and industries. Okay. S&P is an index of 500 large to medium companies traded in the U.S. Index is designed by the S&P, provides representation, U.S. stock market's performance. Companies in the index represent 123 industries classified into 11 major sectors. All right. The point is, the goal of the C fund is to replicate the performance of an index. The index does not have a dividend-adjusted option. So if you're trying to find a dividend-adjusted chart, basically, you can't look at the index. The index charts, like SPX, will tell you what the index did, and that's what the TSP says that the performance is based on, but it's actually not true. The performance that you see as an individual is going to include dividends. Okay, so I've had this question before. Why is my performance better than the performance that if you just looked at the SPX? And it's because the index itself does not include dividends. So SPY, which is an ETF that tracks the S&P 500 index, much like the C fund, is a better representation than the index itself for our purposes, because the TSP, even though it says its performance is based on the index, yeah, it's based on the index in terms of price, but that does not include the reinvesting of the dividends. So I know that's a little bit wonky, and I just wanted to all I'm trying to do is make the data more precise relative to TSP investors versus what the actual words say. So for our purposes, dividends are counted into the C fund, for example, all the funds. So using an ETF rather than the index itself, the chart of the ETF rather than the index, is a better representation of the performance that you would get. Okay. So that brings me to this idea of new TSP ticker symbols. So all I did is to say, rather than SPX, which is the index, SPY is the ticker symbol for the ETF that, again, same as the C fund. SPY is if you were going to try to buy the C fund outside of TSP, that's how you would buy it. You'd use the SPY, and that's dividend adjusted. So for the S fund, VXF, it's a Vanguard fund, and it tracks the total completion stock market index, which DWCPF is what we always used, which aligns with the rules of TSP, but it does not include dividends. So again, if we use a ticker symbol that does include dividends, VXF is a better option. And then we talked about VEU. I mean, it's not a great representation of the I fund. And the more that China and Hong Kong rally, the less of a good representation of the I fund is going to be VEU. So at this point, barring making your own chart of the I fund, we're going to work through some of these things and try to figure it out. But VEU and still EFA, you're going to want to look at. But there's not a simple way to see what the performance of the I fund is right now. And then AGG is still the F fund, because that is the ETF that tracks the aggregate bond index, but it also would include dividends. All right, I know this has been very wonky, but it is what it is. All right, so TSP fund charts real quick. We're in a bull market. We've been in a bull market since the bottom in October 2022. Yes, last summer we had a pretty good pullback, and we had this outlier week right here. But if you're looking at this on a weekly basis, and you're staying in the market when the weekly closing price is above that 20-week moving average line, you're doing good, right? I mean, there was all kinds of concerns about all of this, right? Because we should have had some kind of summer correction, and then a rally, and then a correction going into the election. None of it's happened yet. And we certainly had resistance up here at that 560 on the SPY, 5,600 on the index. But we broke through it last week and continued to rally this week. RSI is not great, right? We should definitely keep an eye on that because we have divergence. The momentum behind this move is weakening, but price, consolidated there on that 20-week moving average line and broke out through some serious resistance. So now that resistance should act as support. S fund. This is the VXF. Okay, so again, it's dividend adjusted. So VXF, S fund is still in good shape, right? It's churning this week, but it had a good breakout last week. Ideally, it got above that channel. and it's finding support there this week. So we'll give it some time and let it resolve itself probably to the upside. But it's kind of churning this week, which is fine. I Fund, again, this is not necessarily the I Fund, it's the VEU. And it includes China and Hong Kong. So it's up 3.7% for the week, but the I Fund is not up that much. It was a good week for the I Fund, but it's not going to be up that much because the VEU includes Hong Kong and China, and Hong Kong and China have had their best week since 2008.
Yeah. Well, I'm going to go on record to say we'll have this kind of fixed for the show and for the newsletters, by next week, because we're going to make our own charts. Now, whether we can get them in the trading view, that's something I'm working on, but so they might look different, meaning, stockcharts.com makes it a little easier, but I still think there's a way to put it up in trading view. But at least that'll give our listeners and our, paid subscribers the ability to at least see the real I Fund and not something close to it. Now, intraday is never going to happen because there's no such thing. Right. So, hopefully they create an ETF. That would be great. But if they don't, the second best thing would be a mutual fund that tracks it. But we'll see.
So the odds of, or not the odds, why would anybody, if you're looking at a chart of China and Hong Kong, and they are at historic lows and they're exploding to the upside this week because China did all kinds of easing, which we're going to talk about in the newsletter. Why would anybody want a product that excludes China and Hong Kong?
Yeah, I know. Well, to your point earlier, though, EFA didn't have it anyway.
Nope.
So we didn't really solve anything. It's just, it's political.
Yeah.
Which I don't even know what that means. And when I say it's political, I should say it's bureaucratic. Politics probably pressured, put the pressure to make it happen. But, when I say bureaucrats, people don't like that word, but if you're a career government employee, that's kind of what you are. And we're the ones that have to execute it, right? And somewhere in there, someone decided this was the best solution to the problem that leadership gave them, and it isn't. Because it wasn't. If anybody would have just said, hey, it doesn't have China anyway. We could just call EFA is ex-US, ex-China. It's not ex-Hong Kong, but who cares? I don't think we're fighting around with Hong Kong right now.
No, they're supposed to be on our side, or that changed a couple of years, 1998. I don't know.
Yeah. All right. We digress again.
I know. And then the F Fund, the F Fund, this is an historic bottom for the F Fund, and it's kind of, it front ran the Fed rate cut, and a lot of people are trying to figure out why, if the Fed cuts rates, the F Fund isn't moving higher. There's a lot of things you could talk about there. The real rate, which is the 10-year treasury rate minus inflation, is much lower. That's like 2% right now, 2%. The Fed funds rate is up at 5%. So the Fed can bring rates down and still not even be close to the real rate. So for the F Fund to falter here a little bit, again, the value of the F Fund is going to be if the U.S. does enter recession and investors flee to the safety of bonds, stocks go down, F Fund goes up. But until then, certainly as long as stocks are going up, you don't want to be in the F Fund anyway. And so why it's doing what it's doing, I mean, who cares? You don't want to be in it if the stock funds are going up. All right. Kind of a wonky show, actually a pretty good one. Had some pretty good railing at the system and all that. I always like that.
Yeah, well, that's what we do when the camera's off. Why wouldn't we do it when the camera's on? All right, guys, if you like the show, share it with your friends. If you have questions, shoot them to us in the comment section wherever you found the video. If there's no comment section, you can always shoot us an email at support@growmytsp.com. And I hope you guys have a great week coming up, and we will see you soon.
Out of here.